Good evening. On behalf of Kuwait Foundation for the Advancement of Sciences, it gives me a great pleasure to welcome you all to this KFAS speaker event. Our goal is to transform Kuwait into a knowledge-based economy, and we strive to achieve this through the promotion of science, technology, and innovation. Tonight, we have arranged to have a special guest joining us to share his insights and expertise. Professor Pedram Mokrian is an adjunct professor at Stanford University and a lecturer at Haas School of Business at UC Berkeley, where he teaches and advises entrepreneurs and Global 1000 companies alike on the topics of entrepreneurship, business model disruption, and technology innovation strategy. He will be presenting tonight's talk on investing in innovation. A kind note before moving to the talk: please note that food and beverages and drinks are not allowed in the auditorium. I would like now to welcome Professor Mokrian here at KFAS. Please join me in welcoming him to the floor.
So this is my first time in Kuwait, but I was actually born in Iran, not too far from here. And we used to have family friends that actually used to live in Kuwait. They would come and visit us all the time. And I remember as a kid, when I was like 4 or 5 years old, my only memory of Kuwait was the fact that this person would bring us ostrich eggs. So it was a really fond memory of mine. And that's the only thing I knew about Kuwait until I came back to visit here now for this program. And I'm delighted to be here. And one of the questions that we're just talking about in terms of what are the topic areas and things, there's a lot of conversations that happen around startups and just the whole innovation macro trends that are happening in the world. But one of the things that's important to understand is that startups by themselves don't just create things, they have to get financed. And that's the piece of it that a lot of people don't appreciate nearly as much. So what I'm going to share with you is actually my background in exactly the space, which is financing startups. So I actually, when I left Iran many decades ago, I moved to Canada, where I grew up there, and I was an engineer. And I was a chip designer, actually, so I was in the high-tech ecosystem. But I decided that I just wanted to shift gears and get a better understanding of how the world works. And I went to Stanford to study quantitative finance. So I became actually an energy trader, of all things. And I looked at sort of the global energy markets. And that was a really interesting journey, but it wasn't really close enough to the core technology, which is what I was used to and growing up in. And so I ended up joining a venture capital fund after I graduated, just by happenstance. So it was just looking at a lot of really interesting things. We started actually making some investments in the energy space. But from there, I ended up actually learning a lot more about a lot of different sectors. So I'll tell you about that fund when I talk about sort of the history of how this all came together. And I'm going to go through a quick presentation, but really want to spend as much time as we can on Q&A because I can tell you things, but I'm much more interested in sort of helping shed light on the things that you're interested in. So without further ado, I hope this is working. There we go. So, capital. The world is full of capital, and there's all kinds of different forms of capital. It's actually $185 trillion worth of value, right? Both in terms of how equities are structured and debt products and everything else. But what we're talking about specifically is private equity and private capital. And what you'll notice here is roughly in this $6 trillion that we're talking about right now, there's that piece in the middle that's focused on innovation. It's a subset of private equity. It's more or less half venture capital and half growth capital. And this is the focus area that we're going to be talking about right now because this is the money that goes specifically to financing entrepreneurs. Now, what does this actually mean and why is this important? To put this in perspective, take a look at the highest valued companies just 10 years ago. 10 years ago, the world viewed value in terms of assets, right? How much assets do you have? How long have you been there? Really huge sustainable bases of revenues. Today, it's markedly different. These are predominantly digital companies. And so the notion of value is changing. But these companies weren't born the same way as the companies that were the highest values 10 years ago. And as you can imagine, the common thread is venture capital. So of the top 10 most valued companies right now, 7 were born from the venture capital ecosystem. So there is something to be said about it. And there's something interesting about the model too. And the more you understand the models, the more you can actually start digging into how does this innovation cycle actually work. And that's what we're going to be talking about this afternoon, or this evening, I should say. So, what is this market? Well, it's pretty huge. On an average basis, we're talking about 250 million, and as 250 billion. But as I mentioned, it's a subset of private equity. And specifically, it's a subset of private equity with three fundamental features, which is high potential, fast growth, and capital efficient. So what does that mean? Well, each of these actually has a very profound meaning. First of all, high potential. When you are in venture capital, you invest in companies that you hope to end up becoming $1 billion at some point. And the reason you do that is because of the fact that you're taking a lot of risk. And so you're investing into a portfolio with the assumption that a whole bunch of a very large fraction, a whole bunch of the companies you're going to invest in are going to fail. And so with that failure mode, you need to make up for it in terms of the companies that win. So if you just think about it mathematically, if I say, 7 out of 10 things I invest in turn to 0, well, the 3 that I invest in have to make up for it. And so as a result, that's why we need to have really, really big outcomes in order to make up for the losses that we have in terms of the risky bets that we make. It's a fundamental departure from traditional private equity, which doesn't take that kind of risk. So you'll never see a private equity investor say that my company might shut down, because that just doesn't happen that way. They structure sort of loss prevention mechanisms there. But in venture capital, when you're investing in startups, when you're investing in 2 entrepreneurs with an idea, there is nothing that you can do to prevent those losses. The second feature of that is this notion of fast growth. Now, why is fast growth necessary? Is because VCs invest out of funds. And these funds are closed-ended, which means that there's a 10-year life cycle on these funds. So to put that in perspective, that means that from the time that I make my first investment until the time that I get the money back out, right, has to occur within this 10-year span. So all of this billion-dollar value creation that we're talking about has to happen in that time. And so the only way that that happens is that you invest in things that have the opportunity to grow really, really quickly. It's just the nature of the business of these types of mechanical funds. Last but not least, they have to be capital efficient. And the reason for that is because we can't concentrate all of our money into 1 or 2 deals. Because when we make the first investment, everything looks the same. So, for example, if we're talking about an investment of, let's say, 30 companies in a fund, all of those will roughly look the same when you make the first investment. You have no idea which one's going to be the winner. As a result, you can't necessarily pick and choose any one company and give a huge amount of money to that one company up front. And so as a result of that, you have to put smaller amounts of your fund at play within each of the portfolio companies with the hope that you can scale rapidly without having to deploy a lot of money behind them. So anyway, so this is the structural reason why you see these startups always strive for really, really quick growth and go after really, really large markets. It's because that's the structure of the money that's being invested in them. So how does this money actually look? Well, historically, we've been talking about something on the order of $50 billion a year. These days, we're talking more like $250 billion. So there's been a lot of interest in this category over the past 6 or 7 years. A lot. And as you'll notice, though, there's something interesting. The number of deals that happen really hasn't gone up. It's just the amount of money that's being put into that. So what does that mean? That means that there's a lot more money being deployed into the same number of companies. So where their saying goes that if you have a really great company, there's plenty of capital to go chase it, it's true. If you really have a disruptive idea, there's a lot of money sitting there that you can actually take advantage of. And what you'll see here is, as I mentioned, in terms of seed, Series A, Series B, Series C, what that means is that this stage of investment, right? So you come in with a seed investment, the next round is Series A, the next round is Series B, so on and so forth. And every time as you continue to develop and progress your company forward, there's a larger amount of money that's available for you because you're taking down the risk of your startup. And this we can talk about mechanically as we kind of move forward as well. So what else is happening? Well, as I mentioned there, because of the fact that we have a lot more money chasing the same number of deals, there's a lot more money chasing growth. Now, this is interesting from both perspectives. If you have a company that you're starting, there's a lot of capital at your disposal to grow. If you're on the other side and you're sitting there and you're a corporation and you're worried about a startup coming and attacking you, this is why. It's because if there is an opportunity to come after your market, there's plenty of money to support that growth. And as a result, there's been a lot more interest by the corporations to try to figure out how to play this game. And as a result, the corporations have now gotten into it as well. And roughly speaking, about 20% of global venture capital is actually from the corporate world. So it's become kind of like an asset class or like a hedge or a next generation way of thinking about R&D. And that's a really interesting thing, within the context of KFAS, because what we're talking about is actually a supplement to the R&D world coming from private capital, which is returns oriented. So it's effectively saying, can we do R&D, or at least the next generation of R&D, the next step forward, using money that is actually designed to start companies and actually create products? So this type of thinking is actually a really good one, because historically, this type of capital has not been available in a lot of these different markets, right? The ideas turn into publications or turn into patents like we've just heard. But the next step is to turn those into products and services, because that's how you actually end up actually getting the returns on that investment. And this is what effectively we're talking about here. And as you can imagine, there's a lot of venture capital sitting in the Americas, but also China. And it's become the next big frontier market for this entire ecosystem, where now about a third of the world's venture capital ecosystem is actually sitting in China. And that's a rapid rise. If you actually look at that, this is a weird graph, and I've actually got a note to myself saying I need a better chart. So it is definitely noted there. But in 2013, it was about 14% of the total market. But now it's 37%, right? So you can see that it's actually taking on a huge component of this global ecosystem. So what are people investing in? Absolutely everything you can imagine. Literally anything you can imagine is ripe for venture capital. Here, we're talking about a few hot sectors. Urban mobility, autonomous vehicles, sharing, transportation, all that entire ecosystem has got a lot of money chasing it. Obviously, with the likes of the Ubers of the world taking on a huge amount of capital and actually going public, there's now a trend to try to chase that in terms of the autonomous ecosystem as well. So that's a really, really hot sector. Agriculture, surprising. So you think about farming and you think about agriculture as not necessarily being a tech-centric ecosystem, but the reality is, because of the fact that it's been so deprived of technology, it's actually the perfect ecosystem to make some investments that are technology-centric to increase the efficiencies and the yields and actually make a lot of money in the agriculture space. And so you can see it's not a huge amount, right? We're talking about a few $1 billion, but it's a rapid rise over the past few years. Healthcare, well, it goes without saying. There's so much that we don't understand about how our physiological, beings work. And so what we want to do is we want to think about what are the techniques that we can apply from the technology ecosystem and industry to get a better understanding of how we actually manage our health and ourselves. So all that's great. So how do you make money? Well, you make money if your company gets acquired or if it goes public on the public markets. It's pretty basic. There's not a lot of rocket science here. And as you can imagine, there's a lot of things that are happening here in terms of the activity to continue to generate the returns for the venture capital investors to continue to invest in these types of startups. And this is just going to be an ongoing phenomenon. And the more interesting part of that is it's a phenomenon that's becoming more global now as well. Speaking of global, where does venture capital actually live? Well, it's kind of concentrated more or less in the United States and like I said, China and Europe. But it's becoming more and more available in a lot of other ecosystems. And what's happening is that ecosystems like here, or just broadly speaking, the Middle East and actually part of North Africa as well, which is sort of another emerging hub, is that they're learning from what's happened in other ecosystems and taking that learning to develop their own internal venture ecosystem as well. And the interesting part about all of this is the fact is you'll notice all of those little circles. So if you look over here at Australia, you don't see one giant circle on top of Australia. You actually see three. That's because there are three distinctly different venture ecosystems in Australia. If you look at the United States, you'll see many, many, many circles. And that's because there are many different venture ecosystems. It's a very localized phenomenon. In fact, if you look at Silicon Valley, which is basically where I'm from, you'll see two circles there. And the reason for that is that if it was actually represented as one circle, you wouldn't be able to see the map. It would just be so huge. So this is about a third of today's venture capital ecosystem lives there. This is what's known as Silicon Valley. And a lot of people are trying to figure out, well, why can't we have our own variant of Silicon Valley? How did it all work? So what I want to do is I want to shed a little bit of light on how the valley was even created. And it's definitely not an overnight phenomenon, right? So just to demystify it, it actually took almost 80 years. So to get a better sense of this, let's go back in time. And we actually have to go way back in time, into the 1930s. The gentleman that I'm showing you here was actually the Dean of Engineering at Stanford, Fred Terman. He took a lot of government funding and financing and a lot of actual public support of new technologies, much like what you see here, especially in the support of buildings, infrastructures, and events like this. But that funding was particularly focused on military-oriented technologies, in particular around communications. But what Fred did that was really interesting is that he actually convinced his students not just to publish papers, but to think about the product orientation of what their technologies is about. And two of his students happened to be these two guys, Hewlett and Packard. And so the first ever startup in Silicon Valley was actually HP. And they were just Fred's students who just happened to be really interesting people, engineers, that were working on effectively the communications technologies that they were researching in school. So Fred encouraged them to go take their go take their company out and actually build a company around it. So they did, and they spun it out. And then he did that again. But the next time he did that, it took a few years. He did it with this guy, Bill Shockley. He's known as being the father of the transistor. Very, very scientific-oriented guy. And he came over to Stanford to actually research the transistor and actually make a lot of really interesting headways from the scientific community as well. But again, much like before, Fred convinced him to actually spin out a company out of this, and that was called Shockley Semiconductor. And then all of these folks that were his engineers ended up, after a few years, leaving Shockley, starting their own little company called Fairchild. Now, there's an interesting thing here around Fairchild. The folks there that you see in the front, Bob Noyce, right? The co-founder of Intel. And this is how the flywheel started to spin up. You had these folks that had seen what a company was about, had understood how to productize technologies, how to really put engineering into practice to create new solutions that the world hadn't seen before. And that expertise over time ended up creating some really deep tech companies like Intel and AMD. So where's the whole venture capital part of this? Right, which all we've done is talk about the entrepreneurs. Where the reality is that Fairchild, as I mentioned, didn't just spin up by itself, it was actually financed. And it was actually financed by this guy, a gentleman by the name of Art Rock. What he did later was he actually combined his background of working with technologies with another investor who was not obviously a venture capital investor, he was just a general private equity investor named Tommy Davis. Tommy Davis later went on to create what was known then as Mayfield Fund, which today is known as Mayfield, and that's actually the company and the fund that I worked at. So the fund was established in 1969. We just celebrated the 50th birthday of the fund itself. And you can see all of the different companies that over time Mayfield ended up investing in, my favorite being Atari, just to put that into perspective. So this little ecosystem went from just being a few people to then being an organization. And these organizations established themselves as effectively what are now known as venture capital funds. And so this is how it all started. But it really didn't hit any real inflection point until the 1970s. The 1970s is where really interesting things happened. In the 70s, you end up with a whole bunch of different companies, right? Just starting up. The entire 70s and 80s were foundational moments in Silicon Valley because all of these really core technology companies were founded. And a lot of these different venture capital funds that you might have heard of started to perk up as well and bubble up. And there was this magical moment when Apple went public. And when Apple went public, immediately there was the creation of about 300 millionaires. And that's when everybody started to actually take notice of this. Because before, Intel and all these things were not really technology companies that people could relate with. But all of a sudden, you got this consumer-oriented technology company, Apple, where now people have not only created an interesting product, but now they've become super rich as well. And that's when everybody starts to take notice. So post-Apple's IPO, you ended up with a whole slew of players getting into it and a whole bunch of more technology companies and so on and so forth in different waves. And different waves in not only the investment capital, but also the types of companies that were actually getting created as well. So where are we today? As you can imagine, continuous disruption, but also a continuous evolution of the venture capital model as well. And this is the type of thing that becomes really interesting for folks to basically say, can we leverage 40, 50 years of an understanding of how the system works, but to apply it uniquely to your local ecosystem? And that's what the really exciting times are right now. So basically, innovation is the key from a technology perspective, but also the evolution of the asset class becomes interesting for us to analyze as well. And to put that into further perspective, if you actually look back from the 1930s all the way through to today, what you'll notice is that all of the blue segments, by and large, were focused on technology companies. Everything we talked about, semiconductors, then networking, then software, then systems, then consumer. Now all of a sudden you say, now we've got all of the technologies that we need to go after adjacent markets. That's why when I said all of these different hot sectors, these are non-traditional venture sectors. Transportation and healthcare, agriculture. The only reason you can do this today is because of the fact that you've got all of the infrastructure. Oops, sorry about that. You've got all of the infrastructure necessary. And as a result, you see a whole slew of really interesting companies that have been created in a whole variety of different categories. So it basically means that this model can now be applied to virtually every single industry you can think of. That's pretty cool. So if you're an entrepreneur, it basically says you can dream up anything and there's probably sufficient capital there to go after. And just to put that into perspective, there's a lot of capital. It's what's known as dry powder. It basically means the amount of money that's sitting that has not been deployed yet. There's about $2 trillion worth in the world. It's a lot of money. $2 trillion worth of money that's sitting on the sidelines waiting for amazing ideas and waiting for amazing growth to happen. So this is a really interesting time. And so a lot of people talk about, well, what's going to happen if there's a trade war, if there's going to be a recession, this, that, the other. Well, this money doesn't go away. This money's still sitting there. It's still waiting to be deployed. It's still waiting for great ideas. So by and large, for innovators, it doesn't really matter nearly as much. Okay, so what I want to do just really quickly is I want to explain just in 3 diagrams how venture capital actually works, and then we're going to open it up for Q&A. And these are the 3 diagrams that I use to describe to people, how does this model actually work? So we've talked about its history, we talked about sort of how it's structured and organized and everything else, but in terms of the mentality, these are the 3 important diagrams to think about. The first one's the J-curve. The J-curve is effectively taking the notion that everybody falsely assumes is reality, which is if you have got a great idea, you wait a little bit of time, and then boom, you become profitable and it becomes amazing. Most startups don't look like this, despite the fact that a lot of people think they do. They don't. They actually look like this. And this entire space underneath this curve has to be filled with capital. And this is effectively what we talk about when we say venture capital. It's used to finance the losses of these high growth companies. From there, we want to start thinking about the placement of venture capital. And it's important in the context of an organization like KFAS to think about this as well, because if you have any amazing new idea, let's assume that it basically goes from fundamental research to applied research to development to launch and effectively to scale, you need money. And this is effectively where that money is. So venture capital is that link that goes from traditional R&D through to large institutional capital and public markets. And this $250 billion that we talked about is effectively this bridge capital. So why do you need that? Well, because people in public markets or large corporations don't understand how to speak with scientists. And vice versa. The scientists, the nerds sitting inside of their labs, don't understand how to talk to the markets. And so this interpretation layer and this money that's required to actually build these initial sets of products and services comes from VC. And in ecosystems that don't have this are basically the ecosystems that suffer from a lack of innovation going from the lab to the market. And so to bridge that, again, this is where the role of venture capital comes in, and this is where risk capital comes in. And this is not grants. These are actual professional investors that think about how to actually connect these dots out. And the last diagram is product market fit. And product market fit is important because it's effectively everything that a startup is trying to do. So when a VC invests in a startup, it's actually investing in almost like an experiment to see if it can get to product market fit. And what that is effectively is the difference between execution, market, and products. That intersection is what we are hoping to achieve. You've got a product that the market has demanded and that you can actually build. And those are the same filters that an investor looks at whenever they hear a pitch. And everything that we talk about, which makes this ecosystem unique, is that it's based on market needs. So the reason startups succeed is because of the fact that in their pursuit of product market fit, they don't have any constraints. All they need to do is just focus on what the customer's problems are and just chase it. Versus existing legacy companies have a lot of other issues that they got to deal with on a daily basis. So the agility of the startup is really focused on their ability to chase this and focus on that magical word. What should we be doing? How should we be addressing these markets? What technologies should we be building? And that effectively then helps summarize why product market fit is so hard for a corporation, because they've got the balance sheets, they've got the existing customers, they've got all this stuff. All the things that you think are valuable are basically creating this rigid structure around which they can't actually chase new opportunities. A startup, basically dynamic team, absolutely no constraints in terms of what it's designed to do, and it can chase whatever problems it wants. And as I mentioned before, there's plenty of money in the world sitting on the sidelines waiting to support these types of ideas. So that, in a nutshell, summarizes our discussion. And what I want to do is I actually want to end a few minutes earlier than I was actually intending to, just because I can sit here and talk about this forever. But what I'd really like to do is talk about the things that you might want to think about, right? Or that you might be still interested or curious in terms of how does the Valley work, how does venture capital work, how to raise money for your startup, whatever you like. So on that note, I'll open it up to you to see if you've got any questions or anything else that you want to have a further discussion on, and we can take it from there. Oh. So if you have any questions, yeah.
Thank you very much for this eye-opening presentation. My name is Salim Al-Hajraf. I'm Deputy Director General of KFAS. I'd like you just to shed some light on how the inventor or the guys behind the startup may kill good ideas because they refuse to give up part of their share ratio to the venture capitalists who can support with marketing, with proper management, with their wealth and experience of taking good ideas to the big companies. Because I believe many and those who are not understanding the venture capital ecosystem underestimate the importance of VCs in the growth. So they killed some great ideas because of the ownership. They keep controlling. They need to control the company, while from the experience of Silicon Valley, many good ideas, the original developer of the idea end up having only 2-3% share of the company, but this 2-3% share equivalent to a couple of hundred of millions as part of a big company.
Yeah, it's such a great point, and it actually goes back to one of the messages that I had before, which is a startup is actually fundamentally different than a business. And unfortunately what happens is people that are so used to sort of this ownership structure of a traditional business, right, whether it's a restaurant or a services company or a small medium enterprise, they believe in the fact that, you know, there's not a lot of that to go around. And that is, unfortunately, it's because of our perception of scale. So when we have a restaurant or we have something that doesn't necessarily scale, then it's important for us to own as much of it as we possibly can. But if you're pursuing scale, then even if you give up a substantial chunk of that company, just the sheer scale with which it actually can get to accomplish its mission gives you that upside. And so the thing that we always say is, you know, you can have 80% of $1 million company, right? Or you can have 10% of a multi-billion-dollar company, which is better. And the more not only local investors, but also the entrepreneurs understand the mathematics of how this ecosystem actually ends up scaling companies out, the more comfortable people are with that ownership structure. And it's really important to also emphasize the fact that venture capital from the equity position perspective is extremely expensive, right? You're giving up substantial portions of the company away for sometimes, you know, at an early stage, very small amounts of capital. But without it, you can never achieve scale. And I think it's the notion of the entrepreneurs that truly want to achieve scale will let go of that fear of ownership and control, right? And do what's best in order for their product and their technology to actually get to market and have the impact it deserves to. And when you see some examples of that happening and people actually becoming multi-billionaires, right, without owning 100% of a company, or even multi-millionaires with owning a small fraction of a company, then that model now starts to become justified and more people become comfortable with it. And so it does take a few companies to establish that precedence in a region, but hopefully once that's established, as I mentioned, sort of like the 300 millionaires from Apple, you start to then create that excitement and that understanding that it's okay to not have the entire company and sort of lose control a little bit.
Just one more question to break the ice for more Q&A from the audience. How can the public fund we have in Kuwait, very small and immature VC community or ecosystem. For that reason, the government established the fund for SMEs. It seems for me, I never rely on them or went for them with a proposal, but it seems as if a parent spoiling their kids by giving them loans with less restrictions, and we end up having many of startups that rely on loan from the fund going down without any hope that they will repay their loan. So how can public funds may impact negatively on the ecosystem that we are trying to push up?
Yeah, so they can have a horrible impact on that. So the first and most powerful negative impact is the fact that they typically come with some form of a restriction or some constraints or limitations on the capital that makes follow-on investors sort of weary of participating. So it's not just the amount of money, but it's the nature by which that money gets deployed is what ends up screwing up the ability for the company to raise follow-on financing. That's the first and most prevalent thing that I've seen across basically the world in terms of all these new ecosystems. The second is that you end up financing and putting into place a whole lot of companies that aren't necessarily born in the right way. And as a result of that, it's not necessarily what we typically would consider to be smart money, right? It's not supportive capital. So as an entrepreneur, not only are you taking sort of venture capital in terms of the money that you put in a bank account, but you're taking the whole network and the ecosystem and the mentorship and the board oversight and everything else that's associated with that. And so capital is only one tiny portion of the value that an early stage investment ecosystem provides. So realistically, that money would be better spent supporting investors who are then going to then invest in those companies and make sure that those companies are successful versus directly investing into those companies themselves. Because to your point, it's sort of like the spoiled child. Like there's a lot of money sitting there, so we're just going to just take it and see what we can do. That said, there's not every single business needs to scale at the scale of venture capital. So there is good placement and good support for small, medium enterprises that are not necessarily designed for that venture capital scale, but it has to be balanced correctly. And if you're trying to create that scale, then you're better off putting that money into the hands of professional investors that understand how to support early stage companies. So it was a very good and deep question.
Please raise your hand if you have a question. And use the mic beside you. Okay?
From the other side of the spectrum, let's say that, I mean, obviously the process of getting seed money, whether it's A, B, C, I mean, it can be quite lengthy.
Mm-hmm.
So are there any resources for entrepreneurs or, guidance or benchmarks to know that we're not getting railroaded? I mean, how do we know that we're okay with a VC? Because obviously an entrepreneur can be anybody,
Mm-hmm.
and walking into a VC fund is almost like going to a shark's tank.
We're not as bad. Our teeth aren't as sharp. So in terms of when do you know that you should be trying to raise venture versus not?
Well, are there any resources to tell you, like for instance, like the gentleman's question about giving up 90% of the company? Do I do that in the beginning of the process? Do I do that later on, like to kind of give us some guidance on how this process goes out?
Yeah, so there's a lot of there's a lot of stuff that you can read online these days. I mean, there's a lot of people with a lot of different opinions, but I think because of the fact that everything you're describing is very ecosystem specific, I think there's a lot of good local resources in the context of accelerators and these sort of tech hubs that you can refer to, where there's a lot of like-minded people that are going through the same journey, and you guys can share notes from that perspective as well. In fact, there's one that I was just speaking at yesterday at Zane, which is really interesting because part of what they're trying to do is actually connect that knowledge gap that exists in terms of, how do you structure a company? How do you think about fundraising? How do you think about product development and the roadmaps and everything else in between? So there are a lot of local resources that are supporting sort of that education, that knowledge gap. And I would first and foremost seek those out because they're a very low risk and sort of non-commercial way of thinking about how to actually get smarter around the space. So that would be the first thing that I would say. Obviously, Google, you can ask Dr. Google anything you want, right? So that works out as well. And then the other thing is to kind of help promote some of this thinking locally by actually creating your own localized ecosystem and your own localized network of entrepreneurs. So even with as much resources that we have in Silicon Valley, there's still a ton of organically organized meetups of founders and entrepreneurs, right, that don't really feel like they fit the mainstream, and they just end up with their own little communities. And once you start to actually talk to other folks, you get the sense of whether or not the things that you're thinking of, first of all, are great or good, right? But more importantly, if they require that external capital or not. And the next thing that I would say is that the best time to raise money is when you don't need it, obviously, but also as a founder, you're constantly raising money. So I would reach out to as many people in your network as you can possibly get to just build that relationship and start to just basically go in there and ask advice. And that advice starts to build up the relationship that you need such that you actually have that mentorship going on. So most of what you saw here when I talked about the history of the Valley, it really started off with a very, very small cluster of people, right? And that small cluster of people communicating and sharing their advice and effectively mentoring each other is what created the spark that effectively ended up creating all these different companies. And that, I think, is the most important thing, right? Is to really seek out whatever mentorship you can find, and don't necessarily be transactional about it, right? Sometimes it's just, sit down, have a coffee, share build empathy, build that trust, and share your concerns, share your thoughts with either a bigger community or just a small network of mentors that you might have, and you'll be surprised how far that takes you. Yeah. But like I said, within these ecosystems, there's more and more of this happening on a daily basis, right? There's more activity, there are more communities being formed, and there's more existing either entrepreneurs or investors that would love to just sit down and talk.
Yes, hi. Just to comment on the lady in front, that there is lots of big companies actually interested in small startup companies. Like, for example, the one that you never think of, like Philips, for example, in healthcare technology, Google as well in healthcare. One example of this is Babylon, which is the app, the GBON app, which recently the founder of the app, he's starting raising funding from different companies interested in technology, which is Google and Philips and so on, just to raise the value of his startup company. But the thing that I want to ask you is that most of the startup companies, which is the entrepreneur owners, they have the exit strategy mentality that to generate the idea, then sell it to the highest number. How to avoid the risk of this, especially if you are an investor and want to invest in a startup company?
So the risk of somebody trying to sell their company quickly?
Most of the entrepreneurs have the exit strategy
Yeah.
mentality,
Yeah.
just to create the idea and sell it.
Yeah.
And the investors will end up with another company,
Yeah.
which is dealing with all the R&D and developing the idea itself.
Yeah, so having an exit strategy is not a bad thing necessarily, but being extremely transactional from the beginning means that you may not be making the best decisions, right, all the time. So there's the only thing that I would say, so I'm not entirely sure if I'm answering your question because I'm not sure how it pertains specifically to the corporate environment, but as investors, the thing that you want to understand is what drives the entrepreneur, right? And we see a lot of different companies, and as a result, a lot of different people. And they fall, broadly speaking, into two different categories. They're either missionary, where they're really on a mission to solve a specific problem, right? There's folks who, lost parents due to, various forms of illnesses and diseases that are, determined to spend their life, solving those types of problems. And then there's people that are mercenaries, right? That are just like, I'm smart, I'm capable, I'm aggressive, and I just want to make money. And along the way, I'm going to create some products and services that people want. And it's okay to be either, right? Not everybody needs to be a missionary. It's okay to be a mercenary. The most important thing is to be aligned from the beginning with your team and your investors as to what exactly it is you're trying to accomplish. So to pretend that you're one versus the other is extremely difficult, and most investors will be able to understand that right from the beginning. Now, in terms of working and building a relationship with the corporations, too early is not a great idea as far as I'm concerned, because really the very, very, very large corporations don't really know how to add a lot of value to super early stage companies unless they have structured programs. The ones that have a very, very well structured and well organized programs can actually absorb, right, all of these different entrepreneurs and you know, shed some light and shed some value from their market back to them. And the ones that don't, so you mentioned like Google and maybe, you know, Philips and everything else. So those are much more sort of innovation oriented companies that'll probably have well thought through programs in place. I'm not entirely sure how much they have here in this particular region and country, but that's typically how it happens in most other parts of the world. The ones that don't are dangerous because they can spend a lot of time basically trying to solve their problem using the entrepreneur's resources, right? And that's basically the most dangerous. It doesn't matter what kind of entrepreneur you are, you'll end up wasting a lot of time working with those types of companies. So I hope I answered your question.
Hi, I have three small questions. The first one was talking about, you know how you explained that the values went from companies, what they had in assets and real life, to like into technology-based stuff within the span of like 10 years.
Mm-hmm.
Do you think this thing will change over time and there's going to be a next thing, or is it going to be stuck with the digital aspect? That's one. Another question is, you said, what's it called? Yeah, you said like, 1 second, I had a brain freeze. You know how you blank out. Okay, I'll go to the third one before I go to the second one.
Okay.
You touched a little bit about the global recession, you know, about coming soon, like
Yeah.
to 2020. How do you think this is, what's your thoughts about it, and can you relate it with the venture capital? And the second question, if I remember it all.
Sounds good.
Thank you.
I'll come back to you on that one. So I think they're interrelated questions, to be honest with you, right? I think the notion of what drives value and what is sort of a prediction or a predictor of value vis-a-vis these types of markets of, you know, recessions and what have you are really intertwined. Sometimes a recession happens because of some form of a incredibly large macro geopolitical event, like a trade war. So who knows what the outcomes of that are going to be. But a lot of times it has to do with sort of an overvalued asset base, right? Where that just needs to kind of go back and get recalibrated. And for example, 2008 is effectively housing, right? The housing markets were incredible. Like the asset wasn't worth as much as what people were deeming it. And as soon as people woke up to that realization and corrected, then you ended up with this massive correction that happened all the way through. In terms of the valuations, I think one of the good things that we're seeing right now is that there's a lot of scrutiny being placed on top of some of these companies that are trying to go public, like WeWork, right? And if you look at the news these days, there's a lot of news around WeWork going public because there's a lot of scrutiny, right, and skepticism around what does that model look like at steady state, right? Or is it just a gigantic bubble of hype? The problem with hype is that it's okay if you're just like a $100 million small private company. But if you're going to be a $50 billion public company and you're still inflating yourself on a lot of hype, it could have some repercussions, right? You're talking about billions of dollars of value basically disappearing overnight, just based on what you see in the news and what can happen. So taking some of the pressure off the market, and seeing some of these things that are happening in terms of devaluation of things like Uber and the challenges of companies like WeWork going public, means that at least there's a healthy amount of skepticism for overvaluing assets. So that's a good thing. In terms of predicting where a recession is going to happen, I thought it was going to happen 2 years ago, but it didn't. So what do I know? Now, you also asked about this distinction between the historic asset-based companies and looking forward at these technology-oriented companies. The reality is that a lot of times these assets, when they're not evolving correctly, will turn into liabilities, right? Think of a house, right? You build a brand new house, right? It's beautiful, it's wonderful, you live in it, and you maintain it, and you kind of keep up with the times. But you kind of stop keeping up with the times over a while, just because it's good enough and it's a house, right? And then 30, 40 years passes. You kind of have liability on your hands, right? unless the underlying land is of value, you kind of sit there with a liability that you have to basically reinvest in or basically destroy and build from scratch. That's effectively some of these asset-based businesses, right? So there's an indication that's saying that we don't believe, right, that going over the next 100 years, that having, big investments in infrastructure in like oil is going to be really interesting, right? Or old school technologies, mechanical technologies, is going to be the most valuable thing. So the biggest thing, right, to think about in terms of how value shifts and evolves over time is to get an understanding of that inflection point between when an asset turns into a liability and what the public's perception of that is. So today, when you're talking about these really, really large companies, right, like these big tech companies, there's no line of sight towards when their position and their dominance in terms of their understanding of data and their personalization of products and media, right, for the mass markets will turn into that liability, right? That means that it's overvalued or valued any less than something that has, a lot of assets, a lot of physical assets associated with it. So will it happen at some point? Yeah, absolutely. There's going to be, it's always a cycle, right? Things are always evolving. There's no such thing as sort of a, the company that's going to last forever. But in the near term, there's not a better model than what we're seeing right now in terms of the public markets to indicate that value. Did you think of your third question yet?
Yeah, I did.
Yeah?
And I think you kind of answered it. It was about how all the companies increased into jumped into the technology wagon, and you have so many explosion of companies doing all these technology-based stuff. So is it gonna, the market now is super saturated, is it good to be investing in it or just wait to the next thing that's gonna come towards you? You get what I'm going with?
Yeah, so because of the fact I'm biased, right? I'm biased towards growth. So I'm always on the search for things that are growing. So if you have a technology company that is in a market where it's got very, very healthy growth rates, where it's not over-investing in that growth, it's happening at a sort of a moderate, cost structure, but it's still rapidly growing, those are really interesting companies, right? Those are the companies that have an indication of being worth, 4, 5, 10 times what they are worth right now. So that's the number one thing I look for. I look for healthy growth rates, right? But sustainable growth rates, right? With a line of sight towards understanding what are the markets that they're playing in, and they continue to grow within that market and overtake, a larger position. And if that's the case, then you're talking about a pretty good company. With companies that are almost, already saturated, it's kind of hard to see how they're going to continue to expand and grow, right? So for me personally, Apple is really hard to justify, right? It's doing amazingly well today, but because I have a growth mentality, I can't see where it's going to go next. And so as a result, I can't see line of sight towards how this company becomes twice as good or twice as big. And so that's not necessarily something I would invest in. I wouldn't short it, but I wouldn't chase it. Okay? And that's sort of how I think about the two opposite ends of the spectrum.
We can have one more question.
Good evening. If you may, I have two questions. First question is, do you believe that in Middle East we have the infrastructure to support startups? For example, I heard it from a lot of people that they are worried about their intellectual property, how they can protect their invention and ideas. And the second question is, there's a mutual benefit, of course, between venture capital companies and startup owners. So do you have any certain, for example, if I have an idea, there is certain characteristics to look in the venture capital companies, looking to the fact that there is a lot of them. And what is the characteristics you look in an entrepreneur to believe that he is going to succeed in this business, or there is certain characteristic in his personality, in his point of any certain thing?
Sure. So let me try to answer that question by giving you some numbers. So in a mid-sized fund, right, like a good-sized fund, like a $500 million fund, like a $500 million fund that would invest in 30 to 40 companies, how many companies do you think, or how many entrepreneurs do you think we speak with in that 3 years that we make the initial investments to get to that 30, right? How many companies do you think we speak with to, you know, in order to make our decisions? Any ideas? 200? 300?
Maybe 500.
500? A lot. A lot is the right answer. 10,000. Okay? So a typical fund of that size will look at 10,000 ideas. We'll probably do something like 5,000 meetings. We'll do probably something to the order of maybe 1,500 or so follow-on meetings, you know, 500 partner level meetings, about 150 would go into due diligence, right? You might, you know, write a term sheet on maybe 75 of those, and then half of those deals you'd actually do, okay? So you're talking about 10,000 deals, right, to boil down to 30 investments. Now, why I'm saying this is because when you meet and hear and see 10,000 different ideas, there's two things that are important. The first thing that's important is the fact that you cannot possibly sign an NDA. So as an investor, it's impossible to sign an NDA because once I sign an NDA with you, I can't talk to all the 9,000 other, you know, people I want to go talk to. And so this notion of like intellectual property, at least between the entrepreneur and the investor, doesn't really make a lot of sense, right? Because the investors are really looking to write a check into an entrepreneur that's going to go build something versus try to steal their idea. So from that perspective, there are no NDAs and there's no IP protection because it's really in the hands of the entrepreneur to go do something with it. And I always find that IP is kind of good, but from a startup perspective, it's sort of like an unloaded gun. Because even if somebody comes and infringes on your patents, you don't have the money to go sue them back, right? So I don't overemphasize the value of a you know, an IP-centric company necessarily. It's more important to have the know-how to be able to actually execute whatever that product is, much more than the piece of paper that says I have a patent, right? Because even if you have a patent, then GE, you know, healthcare, GE Digital goes and does something, right? That's exactly what you're doing. You're going to go sue GE. Like, it doesn't make a lot of sense. So that's the first thing. The second thing in terms of what to look for, really big, like gigantic companies, like multi-billion-dollar companies, it's sort of like picking movie stars. You just never really know until you see enough of them. And there's sort of a lot of intangible, you know, attributes that you internalize that become very, very difficult to actually write down on a piece of, like, motivation and compassion and empathy and blah, 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 like all the good stuff you can think of. But it really comes down to, like I said, observing 10,000 different ideas and, you know, really meeting with 5,000 different people, right, to make those decisions, where you start to recognize some of the patterns of what drives people, what makes them motivated. Are they thoughtful? Are they clear about what they're trying to accomplish? Do they understand how to de-risk their ideas properly, right? Do they have the charisma to go raise additional, you know, follow-on capital? Are they, you know, focused too much on ownership, you know, right from the beginning, where they'll never be able to build a big business because they're going to be their own worst enemy? Right? There's literally 1,000 things that could make a bad entrepreneur. And so what you're really looking for is somebody that lacks all of those bad things, right? And all of a sudden they become like a movie star, right, in your eyes. So I can't necessarily say there's one thing, like don't change yourself, but be as self-aware and sort of as global in terms of your perspective as you possibly can be. And that's basically your best asset. In the companies, big markets, right? Big markets, a disruptive perspective, strong team, any form of traction that's indicated that people are actually willing to buy the products and services, a line of sight towards building that product, right, profitably in the long term. If there's any network effects, those are the types of things that will add a very strong moat around your company. And if you have a strategy towards getting there, great co-investors, strong advisory boards. There's a whole lot of positive things you can think of from a company perspective that you can start, you know, identifying.
I have a sports tech company here in Kuwait. It's called Leb. And I'm suffering now from approaching the investors. So I wanted to kind of ask you, what are the warning signs of a bad investor? Because I'm in a new field, so I'm sports and tech. So sometimes some investors say, no, you're too hands-on, we want more tech, and the other way, and then the other side would be, oh, you're too techie, we want just more sports. And just one investor that I approached recently also asked for dividends. So I wanted to know, is that something typical? And if it is, what would you typically give?
So, no, but I've been here for a matter of hours, right? So my perspective of what's typical is based on a very liquid market that I live in, right, versus what's going on here. So I don't want to say you should dismiss a lot of things, right, out of hand. But no, that's not necessarily normal. I'll tell you the honest truth, right, in terms of getting feedback from investors and seeing if there's somebody that's aligned with you. Typically what you want is somebody that understands the business you're going after. And they're trying to be constructive with the way that they want you to progress and proceed. And they give you very specific bits of feedback that they want to see you accomplish. Remember how I said there's 10,000, right, ideas? So how many ideas do we reject? How many times, right, does an investor say no? If you see 10,000 and you invest in 30, right, like 9,970 times, right, that you're saying no. And just from a human interaction perspective, it's hard to just say no, right? Like, I don't like your idea, or I think you're dumb, or whatever, right? It's a whole variety of different things that people would say. And so what they'll do is sometimes they'll just dance around the issues and just give you some meaningless feedback that's not necessarily useful. So what you should be thinking about is, you know, if there's somebody that truly understands, maybe not the core of the market, but at least where you're trying to get to, and they give you strong constructive feedback as to how to get there, those are going to be the potential investors that you want on board, right? And if somebody gives you some meaningless feedback, or they ask you just like irrelevant questions, then they don't really understand the business you're at, then take it with a grain of salt, right? Every single really, really difficult company that you can think of, right, had a tough time raising money. Like Tesla had a really, really, really hard time raising money, right? It wasn't Elon that was raising the money, right? It was the original co-founders. And those guys were rejected like literally 100 times before they found money. And so as a result, all you're looking for are the people that you trust to give you constructive feedback such that you can then move the business. Maybe they'll become investors long term, or maybe they'll help shape your thinking such that the next set of conversations you have are going to be useful. And dismiss the ones that just kind of like are giving you generic feedback that's not necessarily as useful.
And have a good night.
Thank you.